Right, hi friends, and in this video I want to quickly cover the flywheel of how DeFi is funding my expenses. Okay, so this is a very high level basics, and I go much deeper inside the DeFi house how to structurize it all. But very simply, this is the flywheel that is helping to fund all of the expenses through other people capital, so to speak. So we have the main thing, of course, DeFi LP positions, right? So these are all of the liquidity pools that I deploy capital into. The biggest ones, the low risk, where we have the least volatile ones, of course, stable coins, BTC, ETH, USDC, Solana USDC is a bit more volatile, so USDC, but I mean in general, all of the DeFi LP positions that are generating yield. So those positions are generating cash flow through the yields, of course. So basically, the amount of money being deployed into the different LPs, and I have quite a few of them from low risk to high risk, but all of them are generating some sort of a cash flow, some sort of a yield. And then there are multiple things that I do with that cash flow. The most obvious one, of course, is using part of the yields, part of the cash flow for treasury, which means long-term assets where you don't touch them, you just accumulate, they are stored, cold wallets, multiple ones, etc., right? So essentially this is your treasury. So part of the yield goes to the treasury. Other part of the yield goes to buy some other assets that are free to use whenever I need. So they are not for treasury, but they are also not some sort of for trading purposes. They're basically the same long-term assets that I'm happy to hold anyways. It's just that those are still within the hot wallets and basically are available to use in between lending protocols, etc. when I need to. The treasury is different. A treasury is untouchable assets, the long-term holdings that you are not touching no matter what. And other assets, so to speak, additional ones, are the ones that you are simply buying on a regular basis without caring too much about the price. You just claim some yields. So part of the yield goes to treasury. Also, you don't care about the price, you just buy it for long-term exposure, multi-years exposure, as I've been doing since, I don't know, 2016 or so. And then we have another part of the yield goes to those assets that I'm just happy to hold in my wallet, move it, use it, whatever I have to do, I do. Then another part of the cash flow goes to the reinvestments back into the LPs in case I have to, because there are certain DeFi LP positions that I have where I'm happy to accumulate rather than claim the yields to myself and use it somewhere else. So for example, one of the positions is Aventus, and Aventus I do like to have more exposure, so I deployed into very specific deposit ratio where I'm accumulating more, both of the assets, of course, Aventus and USDC, but all of the Aventus I claim and USDC I swap back to Aventus and back to the pool. So basically I am compounding all of that capital to grow the position size because I want to have as much exposure as possible under these current Aventus prices. So in some cases, part of the cash flow generated is not being claimed, but it's being reinvested and compounded back into the pool. And in the very rare cases, I do claim it. I claim the yield itself and then I spend it. But usually it's if there is some sort of an emergency, so to speak, situation that is extremely rare. I can't even remember when I last time did it. So I don't like to claim the yield and spend it, for example, or use it actively right away. I always like to buy more assets. Every single time, every single week, when you claim the yield, when you do something, I like to get exposed to more market, to more assets, more LPs, whatever. I don't like holding things stagnant, okay? But now, what happens with those additional assets that I buy, right? Because still there, where is the funding thing? So those additional assets right here, and those assets are something like XRP. I mean, I do have two XRP sections, one which is native, untouchable for treasury, and another one that I can actively use to mint Flare XRP, to use it in DeFi, in whatever else I want to do. Also things like Solana, Sui, etc. I mean, multiple basket of different cryptos, okay, just to hold them anyway. Like, why not just buy them and hold rather than hold stable coins? But these are not my treasury, okay? So then what I do on a regular basis as well, I send those additional assets to the lending protocols, okay? So it could be anything. I mean, there are multiple ones depending on the asset. If it's Solana, for example, I send it to Camino in most cases. If it's XRP, for example, I send it to Moonwell because they support Coinbase wrapped XRP. Or if there are available capital, I use FXRP on Kinetics to do on a decentralized matter. If it's Sui, there are Sui lending protocols. If it's any other imaginable thing, I simply find that protocol, lending protocol for that asset that is supported, and essentially, like for example, AVAX. If it's AVAX, I use Aave, one of the biggest, actually the biggest DeFi lending provisions on earth. So basically, I send those assets to lending protocols. And then what I do, I borrow in USDC and spend the borrowed USDC in the real world and move across, do whatever else I have to do, right? This is the flywheel. But borrowing in DeFi isn't free in most cases. I mean, sometimes the borrowing costs are so cheap because, once again, you don't have to borrow always in USDC. If you see that, for example, you are able to borrow in DAI, which is also a stable coin, but if the borrowing cost is cheaper, the interest rates are cheaper, you can borrow in DAI and then convert DAI to USDC and then spend USDC in real world, right? So you can do that as well. But basically, the core idea is that from the cash flow that DeFi LP generates, you buy more assets and you use those assets as collateral, no matter the price of them. And you send them to the lending protocols, and then you borrow against them. You always want to borrow, I would say, between 40 to 50% maximum LTV ratio, just to be safe, so you are not liquidated. But even in the worst case scenario, if market just dumps, I don't know, 70% to the downside, whatever happens, well, you will get liquidated, right? Because your collateral value will drop more than your debt. So the protocol will have to sell your collateral to cover its debt, because the protocol cannot lose money, right? So in that case, well, it's just the market conditions, right? And it still comes from the profits that was generated by DeFi positions. Just instead of claiming the yield and spending it right away, I'm giving myself a chance to get more upside by claiming the yield, buying more assets, all sorts of different cryptos, and just holding them, leave them as collateral, and in case they go up, my debt will be free because I can repay using my collateral. And essentially, if my collateral value increases, I will be repaying the debt risk-free. That's it. Or if that's not the case, if, for example, I bought, I don't know, Solana, Sui, whatever, and left as collateral and borrow against it, as soon as I have active loan, I do another thing, which is, if active loans equal to yes, so if I have an active debt, I will use part of the yield that DeFi LPs generate to repay part of the debt on a regular basis, meaning that at some points, I don't have any debts because I don't need to claim, I don't need USDC, essentially, right? I only need USDC I don't have any leftover capital, so I have to borrow some to cover some spending, right? But in some cases, I just don't have any debts, and whatever yield I generate, I simply buy more assets, reinvest, etc. But if I have to, I borrow against these basket of assets that are in lending protocols, and I borrow against them. And then essentially, if I have an active loan, then I will minimize reinvestments, minimize buying more assets, and I will maximize the yield, the amounts of yield to repay the loans consistently, right? So as you can see, this is a very big flywheel where essentially DeFi LPs, all I have to do to consistently remain within this flywheel is either make my returns higher on DeFi LPs by making the ranges better management, allocations, etc., or increasing my DeFi LP positions as well, which I am doing anyway by reinvesting back into the LPs if I don't have any active loans, right? So you are always aiming to do as the best possible job on managing your DeFi positions so they generate you as much yield as possible. And then what you do with your yield is up to you, and there are multiple ways to grow your capital, to grow yourself as a person through the DeFi cash flows as well. There are, endless ways to manage these things, but this is the flywheel that lets you constantly have exposure to the upside in case the market continues going up, and constantly be able to borrow and spend that borrowed capital and let other DeFi positions repay your debts. So you are basically not touching your own capital, so to speak, because everything else that's happening is being generated by DeFi LPs. Of course, if you're running a business, if you are working some sort of a job and you do have a regular income coming, this is even better because you can then allocate part of your salary, for example, back into the DeFi LP positions, so you grow your positions without depending that much on the cash flow and reinvestments back into the LPs. So this is of course better. The more income sources you have, of course, the better. But even if DeFi LP is just the only thing you have, it's still possible with size to run this flywheel on a constant basis and always be basically covering your expenses without touching your own actual capital, because on a daily basis, hourly basis, your DeFi LPs are generating you the cash flow, the yield, right? You may ask, yes, but what's going to happen if the market tanks to the downside and all of these assets loses value, etc.? I understand, it's a very valid point, but people always tend to think in the worst case scenarios, which is, it's natural, but it's not always the case. You can tell me what's going to happen if the market tanks. Yeah, it's not going to be nice, it's going to be messy. Not the end of the world. Some of my assets will get liquidated, which is the same as I would claim the yields and sell them to USDC and spend that money anyway. I'm just giving myself a chance to keep the upside, because what happens if the market decides to do another 3x in value but to the upside? What happens then? Then it's absolutely amazing because you are making additional income out of nowhere just because you held your assets rather than stables, right? So you shouldn't always think in the worst case scenario. Worst case scenario, your lending capital, your collateral will get liquidated, which is the same as you claiming the yields and selling them to USDC. You just do the borrowing part just to keep yourself in exposure to volatility in case market actually goes up, right? So it's the same thing. Impermanent loss things, etc. This is a very big topic. I can speak on and on and on about this, and inside the DeFi House, I explain in very, very detail how to manage it all so you don't have such a big exposure to LP, to the impermanent loss. But even through impermanent loss, it's a very simple rule. you cannot be in the pools where you are not happy to hold that asset anyway, right? Unless it's some sort of a very quick position using part of your fund capital, where it's this extremely volatile degen type of shit, right? Where you deploy, use leverage or whatever, quickly farm some yields and get out, right? Then in some cases, yeah, it makes sense. But in the majority of cases, in 8 out of 10 cases, impermanent loss is not scary if you manage it correctly. If you are deploying into DeFi using 50-50 proportions, 50-50 deposit ratios, and you rebalance using the same 50-50, then yeah, it's gonna eat you alive. But if you are managing your positions well enough and you're maintaining certain deposit ratios, then impermanent loss can even be your friend. And you can hedge through multiple pools where you have double exposure to two volatile assets. I mean, it's a big topic. But this is the video about how this flywheel can be running and funding your expenses without you actually touching your own capital. So thank you for watching. Hopefully it's going to be beneficial. And of course, as always, I will see you on the next video.